Hello everyone, welcome to the 179th episode of me learning how to trade in Forex. So in the last episode we went through what are the benefits of trading options. So options trading is not without risk, however it can be very attractive for retail traders as it gives you the opportunity to gain a very large exposure with only a small capital outlay, aka using leverage. So options also allow you to profit within short or medium time frames rather than having to wait for months or even years for an asset to move and generate profits. But the benefits don't stop there. Options trading provides some important advantages over other approaches to the market. So first, can allow you to make money no matter what the market is doing. Doesn't matter whether the market's bullish, bearish or even static. There can be opportunities to profit from the options trading. So it gives you three scenarios. If the market is rising, you can make money by buying the asset below the market with a call option. If the market is falling, a put option lets you sell an asset at a set price above the market. Markets go flat. Many forms of trading, it's not a lot you can do except hold on and hope things improve. But with the right strategy, you can use options to make money from an asset that's going nowhere. So you don't need to be familiar with the entire market, just focus on a few favorite currency pairs and become familiar with their movements and patterns, and then you can plan an option strategy designed to earn money from those patterns. Then we've got harnessing leverage. Basically options enable you to trade using leverage. So you can, the amount you pay to open a position is only a fraction of the trade's potential full value. So enabling you to command a large position in the market for a comparatively small amount. As a result, potential profits magnified and so does any potential losses. So how options are used: three main reasons for trading options: speculate on the price movement of various markets, limit your risk by hedging, and trade on volatility or the lack of it. So speculating with options, flexibility of options has made them a popular tool for speculation, as the prices of the options trades vary depending on the number of factors. So for example, how much time you have left to exercise your right to trade and the value of the underlying market. So speculators might trade options with no intention of ever exercising them. Instead, they'll buy an option and sell it on when its premium increases. And we've got hedging. So options trading was first devised as a hedging tool. So say you own stock in a company but were worried that its price might fall in the near future, you could buy an option to sell stock at a price that's close to its current level. Then if the stock levels does fall, you can exercise your option and limit your losses. If the stock's price increases, then you've only lost the cost of buying the option in the first place. So it can be a safety net if you're worried about volatility. And then profiting from volatility. Volatility can be a source of profit too. With options, you can take positions that will let you profit from the variability in the price of an asset, even when you believe that volatility will be low. So maximizing the power of leverage. So options can potentially give large percentage gains from a relatively small initial outlay, but remember the losses are also magnified as well. And then one way to trade options with CFDs, so instead of getting the right to buy or sell the underlying assets, you're trading on the actual value of the option. So CFDs, or contracts for differences, allows you to speculate on whether the asset's price will move up or down without having to actually own the asset. And then we went through the lesson summary. So that's that. Now we're on to how are options priced. So how are options priced? How are options priced? So how are options priced then? Option premiums are derived from the Black-Scholes formula. This is a well-established model that calculates prices based on a number of variables, including current price of the underlying market, expiry of the option. Options with more distant expires have higher premiums than those with closer expires because, as we learned in the last lesson, it takes the options are given more time to actually hit that strike price, so they're going to have to increase the premium for that. Strike price of the option and volatility. So options premiums are derived from the black. Scholes formula. So, which calculates prices based on a number of variables, including the current price of the underlying asset, the expiry of the option, the strike price of the option, and volatility. The strike price of the option and the volatility can be useful to understand the different factors that affect prices. So here are some of the sample mid prices for call options on the FTSE 100 for different expiry months with the underlying FTSE 100 price of 6220. 6220, yep. So a strike price of 6150. I don't really know what this means, to be honest. 6150 February, March, June. Sample mid prices for call options. Sample mid prices for call options on the FTSE 100 for different expiry months with the underlying FTSE 100 price of 6220. So what is the 1 through 5? So this one increases. 6220, that also increases. This one increases, this one increases, so they all increase. Oh, so, right, okay, I see. So, the strike price, so FTSE 100 in February ended up to be, no, this is the options premium price, isn't it? So 6220. So if you done a put a call option for a hit price, strike price of 6400, then in February you would have paid 28. In March you would have paid 53, and in June you would have paid 1339. If you did guess 6150, then you would have paid more than 6400 because it's easier to hit 6150 than it is to hit 6400, so the premium is going to be higher. And yeah, everything else is in between, so yeah. Okay, so some options are more expensive than others. Why is this? Underlying price. The February 6200 call is priced at 105, while a February 6350 call is only at 44. Remember, calls are the right to buy. The right to buy at the lower price of 6200 is more desirable than the right to buy at the higher price of 6350, and so the value is higher. But why is a 6200 call priced at 105? The right to buy 6200 when the market is at 6220 must be worth at least 20, which explains a portion of the premium called the intrinsic value. It measures how much the option is immediately valuable. But what about the other 85 points? Where do they come from? Time left to expiry. The extra premium on top of the intrinsic value is called the time value, or sometimes extrinsic value. The longer the time remaining to expiry, the greater the chance of further movements in the underlying asset, and therefore the greater probability that the option may acquire intrinsic value. Option premium equals intrinsic value plus time value. Right, not all options have intrinsic value. In the table, only the 6150 and 6200 calls have intrinsic value. Oh, so these are obviously higher, way higher than these. At expiry, with the underlying asset at the same price 6220, all the other strikes would be worthless. Time value equals 0 at expiry. Their current value reflects that the price of the underlying asset may change between now and the expiry. Options which have intrinsic value are described as being in the money. Options which have no intrinsic value and therefore only have time value are described as being out of the money. What about at the money? This is simply option which has the closest strike price to the price of the underlying assets. Do this. So some options are more expensive than others due to underlying price. So February 6200 call was priced at 105, while the February 6350 call is only worth 44. February 6200 call is priced at 105, but February 6350 call is priced at 44. Calls are the right to buy. The right to buy at lower price of 6200 is more desirable than the right to buy at the higher price of 6350. So the value is greater because it's more likely to reach it if it's lower, or if it's closer to the was it a 6220, isn't it? So because 6220 is only 20 points away from 6200, whereas it's 130 points away from 6350. So the call right to buy at the lower price of 6200 is more desirable than the higher price of 6350. So the value is greater. But why is the 6200 call priced at 105? The call right to buy at 6200 when the market is at 6220 must be worth 20 points. Must be worth at least 20. Which explains a portion of the premium called the intrinsic value. This explains a portion of the premium named the intrinsic value. It measures how much of the option is immediately valuable. This measures how much of the option is immediately valuable. What about the other 85 points? Where do they come from? So time left to expiry. The extra premium on top of the intrinsic value is called a time value. So the extra premium on top of the intrinsic value is the time value, or sometimes extrinsic value, or extrinsic value. The longer the time remaining to expiry, the greater the chance of further movements in the underlying asset, and therefore the greater the probability that the option may acquire intrinsic value. So the longer the time till expiry remaining till expiry, the greater the chance of further movements in the underlying asset, and so the greater the probability that the option may acquire intrinsic value, greater of the option acquiring or may acquire intrinsic value. So how much the extra premiums on top of the intrinsic value is a time value or extrinsic value. So the longer the time remains till expiry, the greater the chance of further movements in the underlying asset, so the greater the probability of the option, basically the greater the probability of option hitting the strike price. So the greater the probability of it hitting the strike price, which means the closer it is to the strike price, the more intrinsic value is gaining, because the intrinsic value measures how much of the option is immediately valuable. So as long as it gets close enough to the strike price, then that much amount is immediately valuable, right? So the closer it is to the strike price, the more intrinsic value it gains. So option premium equals intrinsic value plus time value. So intrinsic value plus extrinsic value. Not all options have intrinsic value. In the table, only the 6150 and 6200 calls have intrinsic value. I wonder what's the range for which the strike price has to be within to be able to gain intrinsic value. Expiry with the underlying asset the same price 6220, all the other strike prices will be worthless. Time value equals 0 expiries. Not all options have intrinsic value. Only 6150 and 6200 in the table above has intrinsic value. At expiry of the underlying asset the same price, all the other strikes will be worthless. So at expiry, all the other assets would be worthless, as time value equals 0. All other strikes will be worthless. So all other strikes as in everything apart from everything. So 6150 even including 6150 and 6200, right? Or is that only the ones with intrinsic value are not worthless? Their current value reflects the price of the underlying asset, may change between now and expiry. Their current value reflects the price of the underlying asset, may change between now and expiry. Their current value reflects that the price of the underlying asset may change between now and expiry, okay? Options which have intrinsic value are described as being in the money. So options which have intrinsic value are described as being in the money. Options which have no intrinsic value are described as not out of money, out of the money. In the money, and therefore only have time value described as being out of the money. Trigger value and only time value are described as being out of the money. So remember, in the money and out of the money means, so when the in the money is when the underlying market's price is above the strike or a call for or below the strike for a put. So the holder can exercise the option to trade at a better price than the current market price. Whereas out of the money, opposite of in the money, when the underlying market's price is below the strike for a call or above the strike for a put, so the holder can't exercise the option as it will result in a loss. So what about at the money? This is simply the option which has the closest strike price to the price of the underlying asset. The option which has the closest strike price to the price of the underlying asset is at the money. So time decay, if you look at the value of those February FTSE call options with the underlying price of 6220, you can see that the time value is greatest for this 6200 call. This is the closest strike to the underlying price out of the options listed. Time value is the greatest for the 62200 call. So this means the premium is higher because it's the closest to 6220, which is only 20 points away. So this is 70 points away. This is only 20 points away. This is 130 points away. So yeah, that explains why it's got the highest time value. So it's the closest to 6220. Intrinsic value, so how close it is to the actual 6220. So this is 20 points away, 70 points away, yep. Premium, oh, you just add them up. Right, okay. So the more time left to expiry, the more an option will cost. In other words, the time value of an option decays as the expiry draws closer, while the rate of decay increases as an option approaches expiry. Let's take a photo of this one as well. So do that. This is the closest so the more time left to expiry, the more an option will cost. The more an option will cost. In other words, the time value of an option decays as the expiry draws closer. So the time value of an option decays as the expiry draws closer. This expiry comes closer, while the rate of decay increases as an option approaches expiry. So the rate of decay increases as an option approaches expiry. So how the time value of an at the money option decays as time passes. Time value expiry, so as expiry increases, the time value of it decreases. The passage of time is bad if you have bought an option. Every passing day means a decrease in the value of your option. Conversely, a passage of time is good if you're short, have sold or written an option. Passage of time is bad if you've bought an option. The passage of time is bad if you've bought an option, as every passing day means a decrease in the value of your option. But this only applies to when you're not going to exercise the option, right? So you're trying to sell the option on as well. Conversely, passage of time is good if you're short. Passage time is good if you've shorted an option, have sold or written an option. Okay. Strike price. At the money options will always have the greatest time value. At the money options will always have the greatest time value. Options that are deeply in the money are almost inevitably going to be exercised. Deeply out of the money options will expire unexercised. There is more uncertainty with at the money options. Uncertainty means risk for anyone writing the option and therefore means a higher time value. There is more uncertainty involved with at the money options. Therefore, uncertainty means risk for anyone writing the option, so that means an increased time value. Volatility. The last important factor is volatility. Volatility measures the rate at which the price of an asset varies. So, volatility measures the rate at which the price of an asset varies. If the price alters rapidly over short periods of time, it is high volatility. If the price seldom changes, it has low volatility. So high volatility when price alters rapidly over a short period of time. Low volatility when price barely changes over a period of time. If the volatility of a security is high, there is a greater risk of an options writer, and they will demand higher premiums. If the volatility is low, the premiums required will be reduced. Greater risk for an options writer. So the options writer is the one that's going to sell the options, right? So, where is this? Seller of the option is called a writer, yeah, so if volatility is high, greater risk for the seller, But I thought that if there's high volatility, it means it's going to be easier for the strike price to be reached, or if the volatility is high, there is a greater risk for an options writer, so they will demand higher premiums. If the volatility is low, there is less risk for an options writer, so they will demand lower premiums. Oh, I see why the volatility is high, so they demand high premiums. It's because if it keeps changing rapidly, then you're not really going to know exactly what the price is going to do. So it could like shoot up really far, or it could just like drop really low, so you don't really know what's going to happen. But if there's barely any volatility about, then you know that it's going to be around that price, so it's more safe, so there's less risk, so premium's going to be lower. At times of emergency of radical change, such as wars, political unrest, or pandemics, volatility can increase dramatically. If this happens, options premiums will increase accordingly. So at times of emergency or radical change, such as wars, political unrest, or pandemics, volatility can increase dramatically. So the options price, the option premiums will adjust accordingly. Determining how volatile a market is going to be in the future is tricky. Typically, options traders make assumptions about the future volatility of a market by looking at its past volatility. How volatile a market is going to be in the future is tricky. Typically, options traders make assumptions about so it's difficult to determine the future volatility of a market. So traders look at the past volatility to make assumptions about its future volatility. Question 1. Which of these options will tend to have a high premium? Option very close to expiry, option on an inherently volatile asset, option for strike price distant from the underlying market. High premium, volatile assets. Premiums tend to increase when the markets are volatile, and also when an option has long time to expiry or a strike price close to the underlying market. So premiums tend to increase when the market is volatile, when the option has a long time to expiry, or the strike price close to the underlying market price. Interest rates and dividends. Two other factors that could affect the price of an options are interest rates, and for share options, dividends. Share options. Okay. The effect of changes in interest rates tend to be insignificant. Dividends paid out to shareholders by a company will cause the share price to drop by the amount of the dividends. Dividends paid out will cause the share price to drop by the amount. Why would the share price drop if the company's paying dividends? Surely that would mean that more people would be attracted to investing in that company because they are handing out dividends, right? So that would attract people to invest in that company. Okay, by the dividend. Consequently, this will affect the price options on that share. However, as the drop in share prices are predictable, the impact of the fall will be priced into the premium well in advance. So, two other factors which could affect the price of an option: interest rates and dividends. The effect of changes in interest rates tend to be insignificant. The effects of changes in interest rates tend to be insignificant. Interest rates are insignificant for options, okay? I guess it's because I was going to say options are into the future, isn't it? So I was going to say it doesn't matter what the interest rate changes now are like, because it doesn't determine the future, but it could. Don't know. Dividends paid out to shareholders by a company will cause the share price to drop by the amount of the dividends. Dividends paid out to shareholders by a company will cause the share price to drop by the amount of the dividend. Consequently, this will affect the price of options in that share. However, as the drop in share price is predictable, affect the price of options. Does that mean the option price is going to go up or down? So the share price drops, then the dividends. Oh no, then the options price might drop as well, because if it rises, then it's going to be harder for that gap to be closed up, if you see what I mean. So by the amount dropped by, and the options are going to be, this will affect the price of options on that share. However, as a drop in share price is predictable, as a drop in share price is predictable, the impact of the fall will be priced into the premiums well in advance. The impact of the fall will be priced into the premium well in advance. So homework, take a look at the prices of all the call options for gold in your demo accounts. Notice how they change as you switch from daily to weekly, then monthly time frames. Yeah, so this is where the time value comes in, you know. Yeah, the time value, so how much of the option is immediately valuable? Oh no, that's intrinsic value, sorry. The extra premium on top of the intrinsic value is the time value or the extrinsic value. Longer the time remaining till expiry, the greater the chance of further movements in the underlying assets, so the greater the probability of the options may acquire intrinsic value, so higher premium. Okay, so lesson summary then. Options prices are affected by three key factors: the underlying price, the amount of time left to expiry, and volatility. Underlying price determines how much the options is immediately valuable and is responsible for a proportion of the premium called the intrinsic value. The other key element of the premium is the time value, sometimes known as the extrinsic value. This time value decays. Premium falls as the time left until expiry decreases. Premiums fall as the time... You know what, I should probably have that graph actually. Like that. So the time value decays, premiums falls as the time left until expiry decreases. So premium time value decreases as the expiry increases. Premiums increases as volatility rises and decreases as it falls. Interest rates and dividends can affect option prices, but their influence is minor. Premium falls as the time left until expiry decreases. Premiums increase as volatility rises and decreases as it falls. Interest rates and dividends can affect option prices, but their influence is minor. Finally, in practice, options are priced by looking at the probabilities by complicated mathematical processes such as the slow, how I forgot how to pronounce it, black SCHOLES model, and tend to be set by the writer offering the option. Tend to be set by the writer offering the option. Yeah. In practice, options are priced by looking at probabilities. Okay, that's fine. In the next video, I'm going to carry on with this with managing the risks of options trading. So, thank you all for watching, and I shall see you guys in the next video. See you later.